Well, the Fed certainly still has its eye on inflation, which we will get a clearer picture of when we get that CPI report next week. Here to tell us what he thinks is ahead, we want to bring in Scott Ladner, Horizon Investments Chief Investment Officer. Scott, it's good to see you. So let's start with what we just heard from James Bullard earlier today. He's not worried about a credit crunch. He thinks that the Fed should stick to raising rates in their fight against inflation. What's your reaction to that?
Well, look, I mean, I think he's largely right. I mean, we've not seen any sort of contamination or contagion effects stemming out of some of this deposit flight that we've seen out of the regional banks. And there's a pretty simple reason for that. Regional banks don't really do business with each other. They do business with consumers. And so, the thing that caused all the contagion, all the problems in 2008 was that, the large banks trade with each other and they had a lot of sort of interconnectivity amongst them. That's just not the case with how regional banks act. They're more like a buffer system to the financial economy. And so, we think he's right in that, there are probably going to be some losses. There may be a couple more failures, but we do think it's going to be end up being isolated. And we do think we're going to kind of get through this reasonably unscathed with respect to sort of the broader economy.
Would love to ask Mr. Bullard about regional banks who do a ton of business with commercial real estate, and that could be a major issue ahead, Scott. What could that lead us to in this economy?
Dave, you're right. That is the bulk of community banks or kind of regional banks as a business. They do tons and tons of commercial real estate lending because they operate in the local markets and they understand sort of like the local dynamics associated with commercial real estate lending. But there's one thing there's a big difference between commercial real estate lending and residential real estate lending, and that is basically the amount of cushion that that banks require purchasers of commercial real estate to put down. So it's not unusual to see between 20 and 30% down on a commercial real estate deal. That obviously was not the case back in 2006, 2007, in the lead up to the financial crisis, when we had all these liar loans and kind of no money down deals. There wasn't any cushion. There wasn't any sort of room for error in that market. There's a lot of room for error in the commercial real estate market. Not only down payments, but we've seen a lot, tremendous appreciation in commercial real estate the last 3, 4, 5 years. And so the combined effects of that appreciation of the asset values, plus the money down that buyers had to take, to put in to the deal to even get it done in the first place, does give these banks, a fair amount of cushion with respect to the asset values relative to the loan values outstanding. So, while we could have a liquidity mismatch if banks end up having to take some of these properties back, we don't think it's going to end up being any sort of cascading, fast-moving effects. And so, I wouldn't say that there's going to be zero problems emanating from the commercial real estate deals, but we don't think it's going to lead to anything really, really material in the broader economy because of those effects that I just mentioned.
So, Scott, how risky should investors be right now, given the fact that maybe the pullback that we were very worried about is not going to be as bad as maybe it has been feared? Is it time to add some of that risk back into your portfolio?
Probably a little bit slowly, Sean, because there is still there's one sort of hanging chat aspect with respect to what needs to happen in order for investors to feel really comfortable taking a lot of risk again. And that is the market's expectation for volatility of interest rates. So, for instance, the interest rate market, the interest rate option market right now is still pricing the 2-year interest rate in the U.S. to move like 10, 12 basis points a day, which is frankly just kind of insane for the world's risk-free asset. And so until or unless that number comes down to something more reasonable, like 3 or 4 basis points a day, until we get some clarity around what interest rates are going to be in the U.S. and what the risk-free rate is going to be in the U.S., it's really tough to get super aggressive on the risk-taking aspect. And we think that's probably going to change and probably going to come down as we get into late spring, early summer, as we get some more clarity around the Fed and the Fed's pause that we think is imminent. But until we get to that sort of clarity on what our rate's going to be, it's pretty tough to get very aggressive on the risk-taking side. But we think we're getting close.
Yeah, as you point out, a lot of gray between what the markets are pricing in and what the Fed is telling us. Who do you think will end up being right when it comes to hikes?
Well, look, usually the Fed takes what the market will give them. And so, one of the reasons why they hiked last time is because the market had priced in that 25 basis point hike. Right now the market is sort of split. It's kind of a coin flip between whether the Fed will hike in May or not. We think that they probably will, but again, that's a pretty weakly held view. As far as the cuts that the market is pricing in for the back half of the year, we'd probably be a little bit hesitant to embrace those aggressively. We think the Fed is probably like to get to a pause, sooner rather than later, because policy is very restrictive. But we don't think they're really anxious to cut unless we see a lot of weakness in the economy. And we think we're going to see some weakness in the economy, but not probably enough to get the Fed to start cutting rates aggressively the back half of the year.
Scott, lots of focus has been placed on the bond market. More and more investors are saying others need to take a note of what is going on in the bond market because the bond market has been signaling that a recession is coming or that a recession is here. It sounds like you might not agree with that. What's everyone missing?
Well, the thing that they're missing, Shauna, is that usually if an interest rate curve is pricing in a recession, you basically see two humps. You'll see the first hump being, hey, listen, the Fed is going to, they hike too much. And there's a hump going up, and now they're going to have to start cutting, and they're going to have to cut aggressively because they've caused a recession. And then the next hump comes after the Fed is cut to below neutral. Basically cut interest rates a lot. Then interest rates have to come back up, back towards where neutral is, and so you kind of get this S-shaped curve in the yield curve. That's not what the yield curve is pricing right now. The yield curve is pricing right now that the Fed is basically about done, and then they're going to cut slowly back down towards their neutral kind of 3% rate over the next couple 3 years. And so, that pricing of, that shape of an interest rate curve is really more consistent with a, kind of a soft landing or maybe a mild recession than it is any sort of hard landing or sharp recession where the Fed has to cut aggressively and then slowly raise rates back up after the recession has passed.
All right, Scott Ladner, Horizon Investments. Good to see you, sir. Enjoy the weekend.